When conflict breaks out between the United States and Iran, the front line isn't just a battlefield, it's your local gas station. You'll see prices jump before the morning news even finishes. Many ask, why? We don't even buy Iranian oil. But that's the wrong perspective. Oil is priced on a global market, and your wallet is at the end of an invisible chain. When that chain snaps in the Middle East, you feel the friction here at home. The first link is global supply. Traders don't wait for a refinery to explode. They price in the risk immediately. The biggest threat is the Strait of Hormuz, a narrow bottleneck through which a huge share of the world's oil passes every day. If fighting makes shipping riskier or threatens the route, the price of crude oil, the primary ingredient in gasoline, spikes instantly. Even if we produce our own oil in the U.S., our prices follow the global trend. This is a textbook supply shock, sudden scarcity, or even the fear of it, driving prices through the roof. The effect isn't always immediate or equal everywhere. Gas prices depend on refining costs, taxes, and local supply. Some states will see bigger increases than others. While the U.S. has some protection through domestic production and the Strategic Petroleum Reserve, we aren't fully shielded. This leads to why it hurts: the law of demand. Usually when prices rise, people buy less, but gas is what we call inelastic demand. You still have to drive to work. You are stuck in a trap. Because you must have fuel to function, you have no leverage. You're forced to pay the higher risk premium because you cannot simply opt out of the market. The pump shock is just the beginning. Think of the price level as the economy's thermostat. Oil moves the world. It fuels the tractors that plant crops and the trucks that deliver groceries. When energy costs spike, the cost of doing business goes up for every company. This turns a regional war into a national cost of living crisis, raising the price of almost every item in your shopping cart.
The final result is inflation. This eats your purchasing power. If you got a 3% raise, but a war-driven shock pushes inflation to 8%, you didn't get a raise, you took a 5% pay cut in real terms. You can't control geopolitics, but you can control your strategy. Watch the trends and protect your purchasing power before the ripple reaches the grocery store. Knowledge is the best hedge against any shock. Stay sharp.